We have a fantastic event for you today. My name is Steve Kenny and I'm the Chief Distribution Officer at Square Mile. My job today is to guide you through the event. It has only been 1 month since our last event and it has been eventful as always. At last month's event, we saw Mark Manning from the FCA state the regulator's view is that advisors are already under an obligation to ask and to take into account a client's sustainability preferences. And whilst there may be further regulations coming in the years to come, the obligation is already there within the suitability requirements. We've seen the stats for 2021 published from the Investment Association, showing record flows into responsible funds again. However, we've also had Monday's FT, the headline, Green Funds Risk a Red Flag, suggesting this area is full of funds that are greenwashing. As one of our speakers said last year, it's important to you as advisors to understand what's beneath the bonnet in the funds you recommend. We've also seen 1,200 funds globally cut from Morningstar's sustainability investment list, following recognition that they were not sustainable. These headlines do nothing but to cause the consumer to be cautious, and therefore, in our opinion, necessitate the need to secure professional help when investing in this area. The anecdotal evidence is interest in this area is continuing to grow from consumers. And this is before we have the regulations on fund labels and the UK's version of sustainability disclosure regulations, both of which we are expecting the policy statement pre the end of this year with a live date of mid-23. Today, you do have the ability to submit questions to our speakers, and I would encourage you to do so. As we enter the new normal, I'm delighted to announce that we will be holding a Responsible Pathway live event in early summer, the 4th and 5th of July at one of the bastions of academia, Cambridge University, following a similar format as these events of providing practical help in navigating the new age of responsible capitalism. You will see the Responsible Live link, Cambridge, below the button below the screen that you're watching. Please do register. We are working hard to make this a fabulous event. Today's session focuses on impact investing, which is still embryonic in the fund space, but the interest is growing. We have the big exchange and the impact B2C fund supermarket, which is enjoying very strong flows from clients, which is evidence that clients are interested and willing to invest in this space. At Square Mile, we define impact as a fund that wants to use their investments to make a wider, positive, social or environmental impact, as well as meeting their financial needs, and wants to see evidence of the social and environmental impact. Examples would be a fund investing in companies addressing healthcare needs, generating renewable energy, and improving energy efficiency, and that reports on its impact in terms of patients cared for and clean energy. Today's agenda, we have 3 of our sponsors talking about 2025. What's their predictions in relation to responsible investing? We will hear from Federated Hermes, Schroders, and T. Rowe Price. We will then have Richard Romalee, CEO of Square Mile, talking with Jamie Broderick, Director of the Impact Investing Institute, discussing impact investing, the journey so far, and what's next. We'll then have questions from the road. At Square Mile, we have 5 members of the distribution team who meet on a regular basis with advisors. Today, we have John Lester, who is asking questions of our 3 asset manager experts that he has been asked when out and about on the road. Our experts today are from Aberdeen, JP Morgan, and 91. Following questions from the road, my colleague Jake Moeller will moderate a superb panel of expert speakers from Federated Hermes, Schroders, and T. Rowe Price talking about impact. This event does qualify for CPD, and we'll be delighted to supply certificates. We'd also welcome your feedback on the event, so please do complete the questionnaire on responsible investment. Finally, before we kick off with our first session, I wanted to thank our sponsors. You'll be hearing from 6 of them today. However, I would highlight the others who have contributed. Aegon Asset Management, AXA IM, BNY Mellon, Invesco, Jupiter, Elgin, Natixis, and of course the 6 from today: Aberdeen, Federated Hermes, JP Morgan Asset Management, 91, Schroders, and T. Rowe Price. My thanks to them, as without them, this event would not be possible. Now, without further ado, the 2025 predictions.
So my 2025 responsible investing predictions are 3 categories: regulation, resourcing, and reporting. And I would say that whilst perhaps some of these areas might seem a little bit compliance driven, actually one thing that's become very apparent is it's society that's driving all of the actions with respect to responsible investing, and it's cutting across all stakeholders, which is a very, very good thing. And we're seeing that in regulation. Clearly, there's going to be tighter regulation, as well as regulation that drives people towards products which either have responsible mandates or a high quality ESG integration within them. I think that's something that's going to be rapidly occurring in the next 3 years with respect to asset movements. In terms of resourcing, I therefore think that you're likely to see an increase, an escalation of resourcing from asset managers and the asset management community in the realm of proxy voting, in the realm of corporate governance, because whilst you can acquire a certain level of insight from some of the backward-looking data that's available, actually a lot of the emphasis from regulation is around corporate engagement, representing shareholders, effectively talking to corporates to try and create change. And again, that's a very good outcome from responsible investment. And the third area is reporting. And I think this is the area where you'll see, again, tremendous change over the next 3 years, not just with respect to formalizing reporting and the content of reporting, but actually requiring asset managers to introduce certain aspects of their forward-looking insights, their dialogues, how they're holding corporates to account, how they measure externalities in a positive and negative way, which you can't just see from some of the historic data. And there I'm referring to perhaps impact outcomes and effectively measuring the real world impact of companies. And again, this is very exciting because effectively it's being driven by a society, as you've seen COVID and this period that we've been through, effectively create collective action in societies. And I think that's now creating a lot of change across the entire industry. And that change, I think, will ultimately make the industry a lot better to serve stakeholders.
As impact investors, we have been focusing on biodiversity loss, and given the systemic risk that it poses to our planet. Over the last century, we have seen unprecedented real GDP growth, and we have reaped many benefits, such as decrease in mortality rates and technological advances. However, in the process, we have completely chosen to ignore the nature, and we have severely altered 75% of the Earth's surface and 66% of the marine environment, just to satisfy our consumption and energy needs. We are faced with a crisis today, an alarming crisis that we need to address. There is a food crisis as a result of climate change and population growth. In the last 50 years, the number of people on the planet has doubled, but the amount of meat that we eat has tripled. So we predict that in the next couple of years, given the severity of the crisis that we are facing, we will see people moving away from animal protein to alternative proteins. And by the same token, we are also expect to see increased reforestation initiatives around the globe, as well as organic farming to protect our soils. Lastly, we expect to see a formidable increase in recyclable rates for plastic, given that today we only recycle 9% of all the plastic that we consume.
Some predictions for 2025 that include the world we will live in the allocations available to addressing those themes, and the implications for advisors. The world we will live in, before 2025, we will have experienced the warmest year on record, outpassing the 1.8 degrees above pre-industrial levels experienced in 2016. Africa will be home to over 1.5 billion people, over 3 times the 470 million expected to be living in Europe by 2025. Also, India will be home to over 200 new unicorns, which are billion-dollar valued startups. All of this means that investors will be demanding that their allocations are addressing climate change, access these huge demographic shifts, and can take advantage of some of this early stage corporate growth that you get in private markets. On the climate change side, by 2025, we expect $5 trillion of annual issuance for the green bond market. In emerging markets and private assets, already institutional investors are increasing their allocations to these areas. This is a theme that will take hold in the intermediated space. Finally, the effects for the advisory market. I predict by 2025, the term ESG integrated will be no more. Through regulation and investor preference, clients will expect their portfolios to be delivering measurable outcomes, increasing their allocations to impact investing, whether it be themes like climate action, sustainable infrastructure, or financial inclusion, all themes addressed via the Blue Orchard portfolio. Advisors who don't understand the outcomes that their portfolios are delivering risk being left behind.
Well, plenty of food for thought there from our sponsors. And now I'm delighted to welcome you to our next session, which is an interview with Jamie Broderick. Jamie is a director of the Impact Investing Institute, an independent non-profit UK organisation that aims to accelerate the growth and improve the effectiveness of the impact investing market. The Institute is supported by the UK's Government Inclusive Economy Unit, the Foreign Commonwealth and Development Office, the City of London Corporation, and a number of financial services organisations in the UK. Jamie is passionate about impact investing. Jamie, good morning. Nice to see you.
Hi, Richard. Nice to see you. And I'm looking forward to that in-person event this summer.
Cool. Well, you'll be very welcome there. Thank you for taking the time to join us today in what is really an exciting part of the market. Before we go into questions for Jamie, everybody in the audience, can I bring your attention to the Slido app? Please ask questions. This is your session as much as ours. So if you'd like to ask any questions of Jamie, please fire them through on the Slido app and we will get them answered. So Jamie, there'll be many new advisors watching this session, so they won't have seen you talk very eloquently last year at the ESG sessions. Let's start with defining impact investing to make that really clear. There's still some confusion in the market around sustainable impact and so on. So how do you define impact, and how does this differ from sustainable investing?
Well, Richard, we defined impact investments as investments that are made with the intention to generate positive, measurable social and environmental impact alongside a financial return. At the Institute, though, we also differentiate between company impact versus investor impact. And not everybody does this, so there are different views on this. So the question is really, in that definition, is the investor's capital actually causing change? And the one thing I would say to people is that you should, in thinking about impact, you should ignore size. So, not everybody can be a multi-trillion-dollar asset owner. And you should ignore whether you do the impact directly or through an asset manager. We would view those as identical. So that would be our definition, Richard.
Okay, fantastic. Thank you for that. And obviously this market is growing rapidly and some of it is readily accessible, some of it less so. So can you talk a little bit about how advisors can access this part of the market, please?
Okay, well, under this definition, we are looking for, in order to have impact, we would expect the investor to typically be providing new capital. Okay, and so a big piece of this market is going to be the private markets. So it is It's going to be where you're funding or enabling additional activity. It could be tech for good ventures. It could be social housing. It could be additional renewable infrastructure, sustainable forestry. And this is really, this concept of providing new capital applies across all the asset classes. It could be private equity, it can be private debt, it could be real estate and housing, infrastructure, energy infrastructure, SME financing. In the public space, it could also include either equity issues, which isn't that common, but fixed income. So fixed income is quite a big category and typically overlooked. I think a lot of people don't think of fixed income when they think of impact. But imagine social bonds, sustainability bonds, and green bonds being launched and traded on the market. Those would also count as additional activity. But then, Richard, I think the really important thing is, since most of the financial advisors in this audience are actually dealing with clients, placing clients into listed investments, listed equities in particular, I would highlight that we think that if you are using your capital position, your ownership position in a listed company, and using that to engage actively with that company to get them to improve their business practices, that counts as impact.
Okay, so from a public market perspective, where do you see the opportunities? And I think what you've said there from an advisor's perspective, they need to see, or they need to insist and see evidence from the asset managers that they are engaging, as you say. But from a public market perspective, where are the opportunities do you see? And what sectors of the market do you see growing in terms of where the impact investing is being directed?
Well, in the public markets, so in the listed markets, as I say, I think advisors should be paying attention to opportunities to put clients into green bonds, social bonds, and sustainability-linked bonds. Sustainability-linked bonds are not use of proceeds bonds. They're bonds that are linked to the sustainability of the company, the issuer itself. So they're really interesting, flexible. They capture the entire kind of holistically the behaviors of the company. In the outside of fixed income, in the equity space, you can have impact in almost any area. I think a lot of people think that you can only have impact if you're investing in green infrastructure or healthcare, health tech. But the fact of the matter is that if you're using engagement, if engagement, active stewardship, and active engagement is your mechanism for creating impact by pressuring companies, then it's really almost any company in any sector that would respond to investor pressure, so they can improve their internal processes with respect to diversity, gender diversity, with the way they treat their employees, the way they interact with their communities, what their supply chain looks like. And there are people, and I would be among those, who think that even if you invest in polluters, as long as you are leaning on those polluters to plan a path to net zero, then even companies that we think of as being polluters, as long as they're making that transition, that can be considered a form of impact investing as well.
Okay, great, thank you. And as we heard in the videos beforehand, society is driving actions across all areas of the market and cutting across all stakeholders. So that bears that out. Just a question that's come in from the audience here. How do we encourage advisors to recommend impact investments when the returns in recent times have been significantly more volatile than traditional portfolios?
I'm not sure I accept the premise of the question, Richard. I mean, in general, we need to know whether we're talking about impact investing or sustainable investing. So,
well, I suppose there's a more general point here we might be able to derive out of this. I suppose what we've witnessed in markets this year, so a great rotation in markets, growth stocks being hammered, and so greater volatility perhaps in equity markets at least. I suppose the message here is, or what would your message be, having worked in asset management before, is that this is not a straight line, but the expectation is over the longer term that there should be sustainable and competitive returns at the very at the very minimal, alongside demonstrable impact and greater impact being delivered, or greater impact being delivered alongside those returns.
I think one of the mistakes that people have made is they've conflated industry sector returns with sustainability returns. So I view that oil and gas companies are necessarily bad, and then tech companies, because their nature, are necessarily good. But what that does is that then exposes you to the volatility of the tech sector, and what is happening with utilities, including energy utilities. So I think the main message of sustainable investing, and I wouldn't necessarily call this impact investing, but the main message of sustainable investing is that companies that have good practices can expect to thrive compared to companies that have poor practices. At some point, somebody's going to hunt them down and take their poor practices and visit it back upon them, whether it's through excessive exposure to carbon, or through excessive exposure to unfair labor practices or poor practices with respect to their employees. That doesn't play out, Richard, in 1 year. It doesn't play out in the last 6 months. It's a general observation. It's the reason many investors prefer high-quality companies. This is sustainable companies are a version of high-quality companies. And so the thesis on high-quality companies is that over the long term, they thrive and succeed in a way that poorly managed companies do not. That doesn't prevent, over the shorter term, individual sectors from rising and falling, as we've seen over the last 12 months.
Okay, that's very clear, and I would completely concur with that, Jamie. And over time, it is businesses with relevant, sustainable products and services that behave in the appropriate manner, looking after all their stakeholders, that will thrive. And particularly when you've got the social and regulatory agendas going there. Another question on this, and I mean, maybe this is unfair, do you think that impact has a style bias, or can it be agnostic?
Again, I suspect this question is about sustainable investing rather than impact investing, but anyway, I'll sort of address both. Yes, I mean, I think it's what I just described, is that there tends to be a bias toward, there has been a bias. A lot of the companies that are rated high for sustainability tend to be in the tech sector, for example, because the tech sector doesn't use a lot of raw materials, frankly, just so that it's not a big polluting sector. And so there's a natural attraction to the tech companies that are low emitters of carbon. And the problem is, and some of them are very, very large. I mean, if you look at the FANGs and the various, the whole sector of tech and financial technology, then I think you'll see lots of companies that are highly rated, but they're tech companies, and tech companies have always been volatile. That's always been the case. So I think you do find that you can point yourself toward particular sectors, and there's nothing about sustainability that exempts you from exposure to these industrial sectors. So if you're investing in health tech, you're investing in health tech. You're in the health sector. If you're investing in Amazon, you're in the tech sector, and I think you have to know that. And there's nothing about sustainability that gets you off the hook. You're investing in these sectors, and yes, I think so. I think that's one of the things that you need to be watching.
Okay, thank you. There's been lots of chat about a reference to regulation today, and we've seen a number of developments in terms of regulation over the last year or so, and the impact of SFDR in Europe, which came in during 2021, and had a profound effect on flows and demand for funds. Do you think this is comparable to what UK advisors should expect from the SDR legislation, which is currently being brought to the market under discussion with the FCA?
Yes, I do. I think, I don't know if anybody thought that we were going to escape MiFID II, but SFDR is Europe's version of SDR. I think the sustainability disclosure requirements are here. They're out there. I mean, the FCA put out its discussion paper 21.4, which is meant to be, I mean, people think of it as it's an integrated framework of sustainability disclosures for companies and asset managers. But I think what people don't pay attention to as much, I think of it as being a disclosure regime, but actually the roadmap, if you go back, Richard, to when Rishi Sunak launched that roadmap in, I think it was in October, when they launched the roadmap for SDR, they said they're going to also look at how to introduce sustainability-related requirements for financial advisors, which is effectively MiFID II for the UK. And actually, if you look at the discussion paper for SDR, if you look at the FCA's discussion paper, and Steve Kenny already, I think, mentioned this, it says that we already think it's appropriate to confirm that investors should consider sustainability matters in their investment advice, and they need to ensure that advice is suitable and reflects sustainability-related needs and preferences. That's already, from the FCA's perspective, that's already in the rules. And additionally, they will do a consultation on exactly what that looks like. But from the FCA standpoint, advisors are already required to take a look at their clients' sustainability preferences and create portfolios for them that acknowledge those preferences.
And at risk of burdening the audience with loads of regulation, I think it's worth pointing out that at the product level classification, one of the definitions under sustainable is impact, which is what we're talking about today, which is defined as products with the objective of delivering net positive social and or environmental impact alongside a financial return. And then they talk about minimum criteria in terms of intentionality and the ability to deliver and measure additionality through investment decision-making and investor stewardship, impact measurement and verification. So Jamie, from the Institute's point of view, from your point of view, what do you expect to see from asset managers in terms of reporting from impact funds, and what should advisors be looking for?
Well, I think where the FCA is headed is that they're going to define, as you just described, they're going to define impact more narrowly than some people are used to. So, the whole purpose of the SDR is to make sure that people understand what kind of sustainability they're talking about, and so it's a form of taxonomy. But one of the things they do when they talk about impact is, as you mentioned, it needs to be additional. It needs to be incremental. You need to be changing something. You need to measure it. You need to demonstrate some form of additionality. And I think that is a tighter criterion than people normally expect. And so, for example, in Europe, there's this, often people conflate Article 9 investments with impact investments. And I would say, from reading the discussion paper from the FCA, I would say that where the FCA are headed in terms of their definitions, impact is going to be a much, much tighter definition applied in far fewer instances than Article 9 in Europe is.
Okay, and actually there was talk in, I think it was the weekend newspaper, about the SDR being perhaps at a level above SFDR in some of the detail, and to try and remove some of the ambiguities that exist in the European market. But is your expectation then, again, one of the things we saw in Europe were people de-emphasizing and in fact selling Article 6, so traditional funds with no sustainable objectives at all, in favour of 8 or 9. So do you expect to see that in the UK, both from a demand point of view and then from where flows will go?
Yeah, I mean, Richard, I think where we're headed is that advisors will be expected to inquire with their clients what their sustainability preferences are. And most clients will express sustainability preferences. And I think where that leaves you is the so-called Article 6 funds start to look a little bit like stranded assets, which is to say that if you ask your average person, I mean, everybody is aware of climate change, and everybody's aware of the link between capital as a solution, as part of the solution to climate change. So I think you're going to find a large percent, advisors are going to find a large percentage of their client base is going to say, I am interested in having my sustainability views reflected. And that means advisors are going to have to be very literate in what the sustainability solutions for those clients are.
Well, and one of the things we know the FCA are big on, but it's also one of the main issues on the social agenda, quite rightly, is this pursuit. Well, is the threat of climate change, mitigating climate change, and the pursuit of net zero. So, how do you see this unfurling over the next 2 or 3 years? And again, what should advisors be looking for?
Well, to me, honestly, net zero is one of the big themes of this year. I mean, we heard from Ingrid and Jack and Lawrence about some of the longer term trends out to call 2025. I think 2022 is going to hear, which is now, a lot about net zero. It's, we've known about climate change for a long time, but I think what's happened is that we've crystallized around net zero. And if you think about COP26, quite a lot of attention was paid to the fact that $130 trillion had been gathered in support of getting to net zero among all financial providers. That was the so-called GFANZ group. But I think if you think about it, Richard, honestly, take the Net Zero Asset Managers Initiative. That started 15 months ago with $9 trillion and 230 managers. 15 months ago. It now has $60 trillion of AUM and 240 signatories. Now, $60 trillion is basically half of the 120 trillion of managed assets globally. So you can see the momentum behind this. I mean, net zero is huge. In 15 months, we've gone from a start to half of managed assets in the world saying we're going to move to net zero. So you really have to be literate. Advisors need to be literate on net zero. And the other thing I would say is that I think, and we thank COVID in part for this, is that people have started to realize that there are social implications for the transition to net zero. So I think people will become, net zero is a locomotive barreling down the tracks. That's unstoppable. But I think the concept of a just transition to net zero, in other words, it's not enough just to solve the climate problem with the way you invest, but you also have to support a transition to net zero that is also just and appreciates the social implications and the community's impact. I think that's an interesting theme that's going to come out during the course of this year.
And it's not easy. Look at the energy prices now, right? For example, the social impact of this, it's not easy. Okay, so a couple more questions are coming from the audience here. And do you believe the opportunities in private equity and debt markets poses an issue on the level of transparency and consistency of disclosures to help investors?
Well, I mean, generally, private markets are more opaque. So that's absolutely true. That's true of private markets generally, not just impact private markets. I think what's interesting about the private markets, though, is I think it's easier for the advisor and the client to engage with what they're actually doing and the impacts they're creating. So I would say in some respects, certainly in financial reporting, it's harder to get information out of private market investments, but I don't think it's harder to get impact reporting out of private markets. So it's an interesting, impact in the private markets is no more opaque than private markets are generally. But I think from the impact dimension, I think they're just as open as anybody else. I mean, you don't get real-time data, but you do get the data that really matters. And I think that's one of the strengths of the private markets.
Thank you. And of course, you've talked about the huge commitment and growing commitment to net zero. And then actions speak louder than words. So that the actions that follow up after this, the quality of data, the level of reporting, the clarity of reporting, we've heard people talk about greenwashing. How far do you think we are down the road of access to good information to help advisors and meet their clients' needs? Or how far do you think there is to go?
I hate to say this, Richard, but I think there's a long way to go. I think it's an imperfect world. It's an emerging, nascent world of investing. And I think we just haven't nailed down all the information that advisors need. I mean, there are organizations that are springing up everywhere to provide assistance, but we haven't quite come to a consensus on what that assistance needs to look like. So advisors do have access to organizations, including yours, that rate funds and give advisors some guidance on what sustainability looks like, how it's measured, and how that translates into products for their clients. But I think we've got a long way to go. We're just, when you think about the development of financial reporting standards, which sort of started in the 30s, it took several generations before we got to a point where we thought they were really top notch. And I think we're just at the beginning of this. So it won't take 70 years or 90 years, but it will take a while before we really settle in on data reporting that people will find really satisfying. It doesn't mean that you have to avoid it. It just means that it's imperfect.
Yeah, we're all on a journey together, so it's important for advisors there to seek transparency, clarity on whichever methodology they're looking at, and to make sure that the evidence is supporting them and their investors in what they're trying to achieve. I would say that. A couple of other questions here, Jamie, have come in. How do you see the availability of impact investment opportunities moving to the open-ended space? And at this stage, I'll also declare that Jamie is a director of the Schroders Big Society Capital Social Impact Trust, which I realise is a closed-ended fund, but it is a fund that's available in, let's say, the advised market. Perhaps is this a strategy that you might bring to the open-ended market?
Well, I think the logic of the Schroders Big Society Capital Social Impact Trust is that you invest in private markets and then list that vehicle to provide the regulation, the transparency reporting, and the liquidity, and daily pricing, daily transaction. So that's the logic of that. So I have to say, Richard, my favorite solution is to invest in high impact private markets, wrap it in an investment trust, and then list it. That doesn't work for everybody. I understand that. And so, what can you do? I think it's possible to put small amounts of illiquid, high impact illiquid investments into an open-end fund. I do think that people are going to start to pay attention to long-term. The long-term asset fund is an example of a structure that provides, it sort of replicates the European RAIF. If anybody's familiar with the Reserved Alternative Investment Fund, you can build a fund with limited liquidity, so call it quarterly liquidity, that invests in private markets, maintains a certain amount of liquidity to plan for redemptions and transactions. And I think the LTAF, when it comes out, will be available to do that. And I think that may not work for many clients directly, but it would work. I think it would work in discretionary portfolios and certainly would work in DC schemes.
Okay, so questions are keep flying in, so I'll keep running through them. Next one, with the level of growth transitioning to net zero, does this not show that all traditional portfolios will move into this space naturally over coming years?
Yes, I think everybody, just as everybody moved into what's so-called ESG integration, in other words, do we take into account E, S, and G when we manage our portfolios? And the answer is, overwhelmingly, yes, everybody does that. That's just a hygiene factor at this point. I think the same thing will happen with net zero. The numbers I gave you before, if after 15 months, half of all asset managers in the world have already signed up to a net zero pledge, I think you could be pretty sure that over time, that will managing portfolios to a net zero target in 2050 and then interim targets before then will become the standard way to be managing money. And I think that's important for people to understand, because that's a new dialogue in investing that people need to get literate in.
Okay, thank you. Another one here. Could you explain how stewardship is also impact? One is about measurable additional impact. The other is a bare minimum where any impact is achieved slowly. No? That's the question.
Okay, that's a good question. And I think there's an old-fashioned form of stewardship that was kind of an administrative function where you process the proxy votes. And then there's activist stewardship. Stewardship is kind of because it's such an old name, it reflects an old practice. I think the term I prefer is active ownership. And when you turn it on, when you get really active and start to pressure companies to change their business practices, and you start to do some of the stuff that activists like, and I've mentioned share action in this context, getting oil and gas companies to sign up to net zero pledges, getting them to disclose so much more of what they do, changing the membership of their boards, getting grocery stores to increase the amount of healthy food they put on their shelves. That's the kind of activism that changes that does change the way that businesses operate. And because we're working with these are the listed companies, these are large companies. If you can really move one of these behemoths, you really do have an impact. But it's not, it does take a long time. You do need to be patient. You need to collaborate with other asset owners and asset managers to make it happen. But I think it's really impactful. And it's not your grandfather's stewardship, is the way I would put it.
Brilliant. Ladies and gentlemen, we're nearly out of time, as is always the case when listening to Jamie. Time flies past. Two last questions for you very quickly, Jamie, if I may. First of all, what are the focuses for the Impact Investing Institute for this year? And secondly, any last thoughts or bits of advice, and I know there's been plenty in this conversation, that you'd give to advisors looking to get more involved in impact investing?
Well, I think the Impact Investing Institute is active across a number of different areas. I think we've been very active in particular with pensions and getting pensions to understand that they can invest in impact investments consistent with their fiduciary duty. We'd like to expand that discussion to include now foundations and charities and financial advisors and private banks. We think that would be, a great opportunity, an extension of the work that we've done. We're very interested in making sure that net zero is articulated as a just transition to net zero. In other words, a transition in which whatever you're doing on climate, you're taking into account the impact on society. So that's sort of what we're doing. And I would just as a closing observation, I would say, honestly, I mean, we've already touched on this, but I think the trend towards sustainability is established. It's not stoppable. It's going to be constantly reinforced by the visibility of climate change, client demand, product innovation, regulation. I mean, this is really happening. When regulation requires financial advisors to talk to their clients about this, that is not only a requirement, but I think it's an opportunity to really distinguish yourself across multiple generations, cement that relationship, actively engage with the client, and really on the one topic that they really care about, which is what is the money for anyway? And so I think your businesses will be best served by getting yourself embedded in this area and helping guide your clients toward this too. I think there's a tremendous business opportunity here. And I'll close with that, Richard.
Jamie, thank you very much indeed for giving up your time and for sharing your thoughts and wisdom. It's been a pleasure to listen to you, and I know the audience have thought very highly of it. Thank you very much, and good luck for the rest of the year.
Thank you, Richard. Good to talk to you.
Hello, thanks for joining us today. I'm John Lester, Business Development Director at Square Mile, and I'm going to be asking three of our sponsor groups some of the questions we've been hearing from our clients on responsible investment. How do you outline the differences between sustainable and impact?
It's easy to confuse sustainable investing with impact investing, but I think the best way to explain the difference is through the difference between positive effects and avoiding negative effects. So an impact investment should have demonstrable positive influence on a particular aspect of a sustainable development goal. So for example, in the area of climate, we might think that an impact investment might relate to a solution that actively contributes to the decarbonisation of the economy in some way. The criteria for sustainable investment, at least in the way that it's defined by regulators, is lower. Here we're talking more about screens for avoiding negative effects without the need for an active positive influence on that investment environment. However, even here we have to be careful to pay attention to the difference between how ordinary people understand these terms and how they're used in the investment community. So again, I'm going to give you an example in climate. Within most taxonomies around sustainability, it's possible for an investment to be deemed sustainable, even if it's not consistent with, say, a net zero 2050 pathway, So therefore, with emissions growth that would lead to still dangerous climate change of the type that we want to avoid. Whereas I think in the way that an ordinary person uses the word, it's hard to call something sustainable if it is still contributing in some way to active harm. So I think it's important for the investment community to be aware of these differences about not just how the terms are used technically within the industry, but how ordinary users, including our clients, understand these terms.
What reporting do you produce or intend to produce to help advisors and their clients understand the impact of the portfolio they're investing in?
Well, reporting is critical to help our clients understand their investment exposures. And in traditional investing, we have a tremendous range of data points to look at. Region and sector exposures, price to earnings, ROE, duration, spread, credit quality. But when it comes to sustainable investing, we're actually much, much earlier in that journey. But there are still many things that we can do today. So for our sustainable funds, we provide regular reporting on 3 key areas. First, we show ESG scores relative to a benchmark. This allows our clients to see how our portfolio companies are focused on managing environmental, social, and governance-related topics. Second, we show a range of broader sustainability metrics, things like carbon intensity. So how much greenhouse gases are our portfolio companies emitting relative to a broader benchmark. But we'd also look at things like waste management metrics, water use, things like gender diversity, just to provide that overall broad sustainability characteristics. And then thirdly, we often show alignment to the United Nations Sustainable Development Goals. This helps our clients see a tangible impact that these companies are having to help bring us to a more sustainable and inclusive world. Beyond that, we also provide more detailed annual reports that look a bit deeper at the portfolio. We'd show things like a reminder of our investment philosophy and process, some metrics on engagement and proxy voting, and a handful of case studies that really demonstrate how we've engaged with companies and what impact these companies are having. Now, this is just the beginning. Data quality honestly still does need to improve, but we're already starting to see companies report more on things like their carbon intensity and other metrics. And we're also seeing regulations like the TCFD climate disclosures in the UK that are helping provide a bit more structure and consistency to these reports. Our aim is to provide robust, sustainable portfolios for our clients and also arm them with an intuitive framework that really helps them to better understand the outcomes that they're achieving.
What role does impact investing play in energy transition? And what do you look for to evidence this impact?
So we believe impact investing has a significant role to play in the energy transition and also across our wider decarbonisation universe. We try to think about impact in 2 ways. One is regarding company impact, and we really try to find a measurable data point or metric to try and understand what impact a company is having. And that data point we try to look for is something called carbon avoided. Now, when we think about carbon avoided, we're generally looking for companies that produce less carbon emissions relative to the status quo. And an example would be if we look at utilities, we'd be looking at the carbon intensity of the utility and its underlying assets to the carbon intensity of the national or regional grid that it sits within. And if that utility is cleaner, produces less carbon emissions, is less carbon intensive, we would class that as positive carbon avoided. And we can do that across many different companies and sectors. Another way to think about impact is the impact we as investors can have on the companies we're investing in. And there are a number of different ways we try to work with the companies, engage with the companies we're investing in. Now, we try to convince companies to report emissions data, that's across scopes 1, 2, and scope 3 carbon emissions, to try and understand the carbon risks that sit across the entire value chain associated with a company. We also try to push them to plan for and sign up to science-based targets. We think this is extremely important if, as a planet, we are to get to a net zero aligned world. We also encourage them to report carbon avoided and we engage with them on other key sustainability factors. So we do believe the companies we're investing in are having a significant impact across the energy transition and across our decarbonisation universe. And we think as investors, we can have significant impact by working closely with the companies that we're investing in.
Hello, everybody, and welcome to our panel session on impact investing and where it sits in the responsible investment spectrum. I'm Jake Moeller, Senior Investment Consultant at Square Mile Investment and Research. I have three fantastic panelists today, and over the next 40 minutes, we're going to cover all things impact. Just a reminder, please, to keep those questions coming in on the Slido app. We have some good session questions there for Jamie. We've got three excellent panelists here. Let's pick their brains as much as we can. I'd like to introduce Jack Wasserman, is the Investment Director of Impact Strategies at Schroders. We have Lawrence Taylor, who's a Portfolio Specialist at T. Rowe Price Global Impact Equity Fund, and Ingrid Kukuljan, Head of Impact Investing at Federated Hermes. The first question I'm going to ask each of you, and I would like to start with you, Ingrid, if I may, is what exactly is impact mean? What does it mean to you? And what does it mean for your company's value proposition? Ingrid.
Morning, Jake. Morning, everyone. Great to be here today. So it's a great question. And what we usually find is that there is still a lot of confusion between the difference in terms of impact and sustainable investing. And if you look at the sustainable company, it integrates all of the ESG factors and it seeks to do no harm. But impact investing goes beyond that. We consider it the future of investing. And the reason for this is that ESG integration and doing no harm are already part of it. And what it seeks to do is identify companies that have a positive impact on planet and the society, as well as ability to generate financial gains. So the way that we see impact, and in our impact fund, we're looking for companies that are providing innovative solutions to the world's most pressing needs. And we seek for companies that do so in alignment with the UN SDGs.
Thank you, Ingrid. Jack, could I just get you to sort of talk about impact from your perspective? Not everyone will be familiar with the relationship with Schroders and Blue Orchard.
Yeah, thanks so much, Jake, and welcome to everyone from me. Thanks for having us. Blue Orchard are an emerging market impact manager. It's something we've been doing for over 2 decades. So everything, and what we mean by that is everything we look to do is looking to deliver a positive social or environmental outcome alongside financial returns. And I think actually Jamie and Richard summed it up perfectly in the previous panel. Impact investing is that intent to contribute, I provide additionality to delivering a measurable outcome. And those 3 pillars are central to everything we do at Blue Orchard. And we actually operate across the spectrum of capital, so including private equity, sustainable infrastructure, private debt and microfinance, as well as listed debt and public debt and green bonds and social bonds. And we think it's absolutely critical to understand the levers available to you as an asset manager and as an owner of that instrument, whether it be public debt or private equity. Your ability to deliver change and therefore deliver impact differs, and the tools available to you differ. So we think it's absolutely critical to for investors and asset managers to recognize what levers are available to them as an impact manager.
Lawrence, T. Rowe Price Global Impact Equity Fund, perhaps the clue's in the name, but then again, perhaps it isn't. Give us a bit of an outline of what it is you're trying to achieve at T. Rowe Price.
Thanks very much for joining, everyone. We are trying to look for a future understanding of a business, its real-world impact on the society or the environment in which it's influencing our planet, and then specifically trying to map that to where we see the economics of a business being on the right side of change, meaning can a company monetize the positive impact it's having, net of any externalities, to leave you with a good investment but one that also has a societal and environmental good attached to it.
Excellent. I'd like to move along to, we've heard a few of the tailwinds to impact. Regulation was mentioned, consumer changes and shareholder activism. I mean, what do you see in each of your firms as some of the drivers of impact, and how does it fit in with some of the zeitgeist that we're hearing about things at the moment, climate change and so on? Ingrid, if I could get you to pick that up first.
I think COVID was a turning point for impact investing. It's actually caused a paradigm shift. And the reason for this is that it has made society, policymakers, and companies themselves realize how many weaknesses and critical issues we are facing, water provision, food provision, the global supply chains. It's also put a spotlight on worker rights and the gig economy. So we have seen a huge interest in impact investing. And the reason for this being that obviously takes into account all of the stakeholders, not only the minorities. So we have seen a lot of capital shift towards these strategies, but still it's such a small portion of the overall AUM that, if you look at what we are facing in terms of the annual deficit, in terms of the UN SDGs, we are at 2.5 trillion today. This is without taking into account any of the COVID headwinds that have contributed to an even worse situation, especially in the EM. So we are seeing the capital coming through, but there is much more needed in order to resolve these big issues. And what impact investing allows clients is to monitor the goals, all of these issues that need to be raised, and actually to be able to map and to report back on individual UN SDG goals and how their capital has helped, contribute to improving or resolving some of these issues.
Jack, you've been involved in private equity markets and infrastructure for a while. I mean, what do you see as some of the tailwinds driving the share classes, the asset classes that you deal with specifically?
Yeah, I'd agree with all those comments that we had, and maybe actually taking a step back and definitely very relevant for advisors, and something we see as a strong tailwind is this intergenerational shift of wealth. And to use an anecdote, I was in a meeting with an advisor who's speaking about a family that they were looking after, who's the principals now started to bring their granddaughter along to some of the financial meetings. And she sat patiently waiting throughout the whole meeting, getting an update on their affairs. And she asked one question at the end: what's the carbon footprint of this portfolio? And I think it is critical for advisors on the line now to recognise and understand, and I mentioned this in the predictions short video, to understand the outcomes. What are those risks within your existing portfolio, and being able to understand that, because the people who are going to be taking over the wealth care about this, and more we're getting pressure from regulation already. But I think that is a huge tailwind for impact investing generally, the fact that those who are gaining wealth see this as central to their financial portfolio.
Lawrence, you've worked intently over the last couple of years creating a new proposition for your firm. You would have surely considered some of the tailwinds, what might drive the success or otherwise of that product.
Absolutely, and it's a really interesting observation that it's, I think, society that's driving this change. I think governments have been horribly inert, but governments are voted in by society, and that pressure, which has been enhanced by COVID in this period that we've lived through in this last 2 years, which have been extraordinary. I think that has been a pressure that governments have finally responded to, which has then come on top of, I think, some of the very large asset owners of the world, meaning clients, meaning those that we run client money for. And we've seen this want and this pressure to effectively be more material in ESG engagement, to understand businesses and their externalities. And now we're starting to see, I think, societal change actually direct dollars, pounds, euros towards businesses that have better footprints in any way they do, whether it's societal or environmental. And that's now, I think, starting to lead to regulation, starting to lead to governments and regulators effectively putting in rules around some of the products which have been created to respond to some of these demands. So I think it's fascinating because I find it very hard to see that society's demand for more sustainable and positive impact footprints is going to reverse. And I see that governments are going to keep accelerating some of the rules and regulation around effectively how we will invest, how we need to report, how we need to communicate, and how as we as fiduciaries, we need to engage with companies. So I think it's a really interesting time. And I think there's definitive longevity behind some of the tailwinds that should ultimately redirect economic profit to some of these businesses that have good environmental and social footprints.
I'd like to talk a little bit about the perceived risks or the actual risks of impact investing. It is at one end of the responsible investment spectrum. Is there increased risks such as increased liquidity risks? Are there concentration risks? Orsted is a company that everyone seems to be investing in these days. Or are the risks more general, like not delivering to the conversation that Richard and Jamie had around intentionality and additionality? Perhaps if each of you could outline some of the risks. Ingrid, what are some of the risks of impact investing for you?
I think the biggest risk is your last comment, and this is not delivering on intentionality. This is a key tenet of impact investing, as is additionality. And what we are finding is that the regulation is still not tackling this, but for us, an impact label without quantifiable outcomes has no value. And the trouble that you have is this is probably one area of the market where you need to be an active investor. We have developed a proprietary impact database where we quantify the outcomes of each one of our holdings. And if you're investing via passives, this is very difficult to do. So this is, one area that should definitely be tackled and that we see as a big risk to clients. Otherwise, in terms of liquidity, we don't see that many issues, to be honest. There are many more companies that are coming to the market that are providing these innovative solutions to societies, and environments pressing needs, but also existing businesses that are transforming themselves and becoming more impactful. So this is one side that we don't see as a risk.
Thanks. Jack, we had heard earlier about the performance of some of the listed mutual funds in January, which was very, very volatile. I mean, is one of the risks perhaps somewhat mitigated by a diversification effect with some of the other assets that might be brought into a portfolio for an impact investor?
Yeah, I definitely think so. And I think whenever building a portfolio, I think looking for diversification and appropriate risk management is critical, whether you're looking at a sustainable or impact portfolio. And you touch on there, and Jamie and Richard did in the previous discussion around the power of private markets to delivering impact and to delivering additionality, i.e. new capital directly going into the projects and areas where it is needed. And Blue Orchard actually sit within the Schroders Capital Private Markets business, which is a $70 billion business, which sits within the $700 billion business of Schroders. And really it's around trying to deliver consistent processes. It might be a boring word for some of the advisors, but actually that's what leads to transparency and integrity and ultimately great reporting. And we've looked to transfer that 20 plus years experience of being an impact manager in the emerging and frontier markets across not only everything we do at Blue Orchard, which is $4 billion. I mentioned we run a couple of UCITS funds in the fixed income space, but also everything that we're doing across Schroders Capital, so that we know and clients recognize that when Schroders say the word impact, actually we have got the tried and tested processes, procedures, management frameworks in place that have been developed for over 2 decades. And the final thing I'd mention, and I know we might touch on reporting, This all comes down to transparency. And I think leaning on industry best practices, whether it be the operating principles for impact management, known as the impact principles, and I would urge all the advisors here to Google the operating principles for impact management, set of 9 principles that produce best in class processes. The final stage of that is external and independent verification. And we think that is one of the ways of mitigating the biggest risk in impact investing, and that is greenwashing and impact washing.
Lawrence, how do you, as the brains behind a new proposition, ensure the intentionality and additionality of your product, and how do you address some of these risks that an advisor might be concerned about for their client?
Yeah, it's a very good question, because it's one I spent 18 months thinking about, and it's to be clear, unequivocally the case. There's risk both in terms of the return proposition, because when you run an impact fund, the outcome is incredibly high conviction. If you can't own the FANGs, you can't own many consumer stocks, you can't own most of the commodity complex, and you can't own a lot of developed world banks, you ultimately have an incredibly high conviction portfolio. Albeit, if you then execute with good impact analysis and good financial return analysis, the definition of high conviction and the nature of it can lead to very, very good things. And then you've got obviously risk in terms of the reporting aspect. And the way we've gone about addressing these things is the mandate of an impact investor is to be material, measurable, additional, and we've put resilient in there. And resilient is making sure you have appropriate diversification, making sure you don't just crowd into the areas which are most obvious and backward-looking signals of impact or sustainability. You've got to think very, very hard about risk control within this type of mandate. And you have to build, to Jack's point, the appropriate infrastructure in terms of having a responsible investment team, having forward-looking analysis, having backward-looking reporting, and being able to, coming on to the reporting aspect, be incredibly comfortable being uncomfortable in your reporting, being very open about what you can measure, what you can't measure, how you put layers of process in place to think that if a company is aligned with the SDGs, if you've done 5 dimensions of impact analysis, if you can measure many stocks but not all, is that going to merit both the product proposition and the investment as we then develop the tools to be able to standardize reporting, as the whole industry develops the ability to oversee and verify impact management. That effectively is an old-fashioned approach that I remember 20 years ago, which is speak to your clients, build a relationship, be open, be frank, and ultimately let them judge you based on all those different dimensions. But it's one that perhaps is pretty uncomfortable when you start to go down this path because it's complex, and you've got to be frank and open about that with your client base.
The Financial Times article on the weekend, which Steve Kenny has mentioned, had some really interesting views. It did address unintended consequences, perhaps the unintended consequences of trying to invest in this area passively, or, for example, a lot of portfolios end up with a lot of financials in the portfolios, and a lot of investors don't see banks as being necessarily a force for impact. Jack, I know you had some views on that, and also scalability, perhaps investing passively for impact.
Yeah, and I guess in operating the private markets as well, we're as far away from an index as you can get, I think. But you touched on financial inclusion, which we see as a core theme, especially in the emerging and frontier markets. There are still, unfortunately, 1.7 billion people who don't have access to basic financial products. So tarnishing all banks with the same brush is a risk, and I think that actually gets to the core of what impact investing is. By definition, and Lawrence and Ingrid have touched on this, it has to be bottom up. You have to do the work at the company level, at the asset level, at the project level, to understand what the risks are and also what the impact opportunity and financial opportunity is. And equally, as an impact manager, you should be looking at the impact risks that are potentially here, not only not achieving the impact, the intended impact, but also what are your second effects that might happen. And this is where the concept of the just transition, I think, is critical when investing for climate change, recognizing what are the social implications of a wind turbine in someone's backyard. What are the implications of a hydro plant, for example, on society? So it's critical, these two themes, even though separated, do go hand in hand, and should do when you're looking to do your impact analysis.
Before I move on to evidence, Ingrid and Lawrence, anything further to add on unintended consequences or the passive investing? Lawrence?
Lawrence, go.
I mean, I'll be really clear. I don't think you can have a passive impact fund. Having seen what it takes to build a credible approach where you can understand or hope to understand the future consequences of a business, I just struggle to see how that sits with being able to understand what a business is today and what it was in the past. Albeit, obviously, from a passive perspective, you can clearly do engagement and you can clearly do proxy voting to try and be additional in that dimension. I don't think you can position for impact within a passive fund, being very clear. So that would be my primary comment there.
Okay, before I move on to data, which we are coming to, we have had a question on risk from a member of the audience. How do you manage liquidity risk versus impact versus return? Perhaps, I saw you nodding there, Ingrid. Would you like to tackle that one first? How do you manage liquidity risk versus impact versus return?
So, for instance, our rule of thumb is that in terms of liquidity, the company's daily trading volume needs to be equivalent to 1% of our NAV. So we remove any sort of liquidity risk straight away from that point of view. And as I mentioned earlier, we are not finding difficult to find, liquidity and companies in the markets to invest in. We are running a very concentrated portfolio, and the reason for this is, to go back to some of Lawrence's points earlier on, that obviously we exclude a number of sectors because they're not impactful, but the companies we do invest in are exposed to scalable and secular growth factors. So, it's quid pro quo there. So we don't have any issues with liquidity.
Jack, Lawrence, anything to add on that?
Nothing further.
I would just say we talk about the balance and the skew of impact because, to be clear, every company has got a footprint and you need to be able to understand that in the context of the good that a company might do. In terms of liquidity, that's, again, another dimension of risk control, that you need to understand the liquidity of a business in the context of its current and its future size, scale, and you need to have a degree of breadth in your portfolio, as well as, quite frankly, an understanding of the scale of any individual strategy when you've limited the opportunity set as well.
Excellent. Okay, greenwashing is a big fear for many clients and advisors. I mean, the great thing about impact is we all talk about evidence, and I think it's important to back up a proposition with evidence, but how do we measure evidence? What are the effect and the benefits of evidence? How do we ensure data consistency? It strikes me that there aren't a lot of off-the-shelf solutions for evidencing impact investing. Ingrid, could I get your views on that, please?
Sure. Well, maybe to start with your point that there are not enough off-the-shelf solutions. We couldn't find any. And the reason for this being that obviously as impact investors, we look for granular data and we really, go deep into detail. and we couldn't find anything that satisfies this. Second problem is that looking at the net benefit analysis, you're looking at the inputs and the outputs of a company. So it's not only important, how many emissions the company is helping to avoid, it's actually important to look, how many emissions that company is also generating. So we set out at producing our own proprietary database. It took us 8 months. Database has over 20 KPIs, and we have 2 years of data now, and we are using it in the same manner as we look at the financial accounts, i.e. we are monitoring the progress in terms of various impact KPIs of our companies. What was interesting in doing this impact database, we did it in conjunction with our investee companies. We back calculated all of the numbers that were given by them as well. The interest from the corporates themselves when we did this database, and actually some of them will be using some of the KPIs to report. Corporates are very interested to understand, what is the best way to report on impacts. They understand the importance, but they're inundated with various information being thrown at them, as well as requests. And lastly, what we are doing, and which is essential for impact, we engage, and we are very fortunate that we have EOS, which is one of the global leaders in engagement in-house. We have 1.7 trillion of assets are under stewardship today. And last year we engaged with over 2,000 companies. So despite the fact that, for instance, our fund is very impactful, last year we still engaged with 80% of our holdings. But what's interesting there is, and this is the evolution of the corporates, only 10% of our engagement was around the E, and all the rest was around the S and the G. And that just shows you how impactful the businesses that we invest in are already. So with the impact database, we have accountability and traceability for our investments. We can explain every number behind the decision to invest in company. But more importantly, it gives our clients the opportunity to actually report on how their capital has helped the achievement of individual UN SDGs. So we can actually produce custom reports that allow clients to see the impact on the company level, portfolio level, and their own capital allocation level.
Jack, if I was to put on an auditor hat and ask for you to show some evidence as to what you do, what would you point to from your experience that would give me some reassurance that what you're doing is actually changing the world?
I'm so glad you asked the question in that way, Jake, because that's exactly what we've done. We've had external independent verifiers come into our business and have a look at our processes and show, and then independently report back to us where these align to best standards in delivering consistent impact. And actually, it's something we're clearly happy to share with investors. And this, again, goes back to the operating principles for impact management. It is essentially an audit on your impact process. And it's something which we think is critical to avoiding greenwashing. It is getting someone outside of your own shop to come in and actually look under the bonnet. And in some areas, we learned a huge amount as well about where we can improve and how we can deliver better quality and more consistent impact, because it goes back to impact governance. How are you as an organization or a product set up to deliver repeatable impact? And the way we do it in our public debt businesses is we separate the two functions. So we have a internal but independent impact team that are responsible for the impact analysis of each and every bond and issuance. And only once that is approved do the portfolio management team then get that investable universe and try and deliver on all the things a PM does: risk, return, liquidity, diversification, etc. And so we separate those functions, and we get a independent external verification to come in and not only kick the tires, but go in detail.
Lawrence, how important is data for you, and how do you overcome the inconsistent data reporting that we are subject to?
Do you mind, Jake, if I answer your last question and then run on to that one? Because I just wanted to give a data point, because as we've taken our strategy launch through Australia, the US, the EU and the UK, the FCA has unequivocally got the best, toughest standards that I've seen anywhere in the world. And that's really encouraging. And it links back to your question, because the level of data, the forensic nature of the questions, which came in terms of show us your key performance indicators, show us your analysis, show us your thesis, describe in the prospectus how you're going to measure real world impact. I haven't seen that type of detail asked for in a client prospectus in my career. And again, that's all very intentional by the FCA around putting standards around products. So I just wanted to comment on that, because I think in the UK, actually, it's a really encouraging sign the FCA is doing a good job. Now, in terms of trying to standardize data, that's where it does become at times challenging, because I've looked at all of the very best impact reports around the entire industry. And I think that's where the community of impact investors can start to help clients by saying, these are the minimum standards. This is how we show exposure. This is how we can show alignment. This is how we can show an openness of our thoughts, our thesis. And then the final piece that needs to be standardized is the actual real world measurement of environmental and societal impact. And in an environmental dimension, it's getting easier as companies report, as you can start to accelerate that reporting through your engagement to effectively give clients what they need. In a societal dimension, it's still pretty challenging to be able to aggregate the amount of impact from one of the companies that helped bring the Moderna vaccine to market with speed and efficacy, and what that means in terms of lives saved, the contribution of that business by doing it quicker and with more efficacy, versus, say, a clean energy utility where you can measure its carbon footprint, and through science you can start to measure the amount of carbon saved through its solar and wind production. It's going to take some time for our community to be able to effectively agree standards, and partly it's data dependent. And if the data isn't there, you can't guess, you don't want to overestimate. And that's why it's really important, coming back to the nature of impact investment, that you need more than one aspect of measurement. So we look at alignment with the SDGs. We show our work in terms of a 5-dimensional analysis of a company in an impact dimension to lead to the KPI, the indicator that we're going to look for. But impact is slightly separate. That's the gold standard that we're all trying to get to and search for. That might take a little bit of time, which is where, again, that client fiduciary relationship is going to be very important as we move towards that end goal.
Jake, could I add on to that, because I completely agree with everything that Lawrence has said there, and actually one of the differences between private markets and public markets. In private markets, we are the owner operators of the business, so engagement takes a different level. We sit on the board of these companies and are steering the strategy. We can also therefore demand the data points that we produce, whether it be number of beneficiaries, whether it be around clean energy. In the public market space, clearly for all reasons we're aware of, we need to be able to operate and produce these reports with the information provided that's in the public sphere. And that's where understanding the materiality of a data point, and I think Lawrence alluded to that as well. Actually, we're intending in this fund to deliver this outcome. What are the material data points that I need to look for in that business to be able to make that decision? And I think that's a key difference between the public and private markets.
There are some questions coming in. Just before we get on to those, and I will leave time for them. Ingrid, you have mentioned, in fact, Lawrence has mentioned it as well, but Ingrid, you mentioned the United Nations Sustainable Development Goals. Perhaps very briefly, could you outline for our advisors why they are an important means of mapping a portfolio to an impact outcome?
Sure. If you look at the UN SDGs before the announcement of UN SDGs, I would say that impact was mostly the domain of private markets and NGOs. But the sheer size of the financing needed to resolve the world's most pressing needs, be it of the society or the planet, which are identified by UN SDGs, has shown the need of the public money going into the market. If you look at the 17 UN SDG goals, there are 169 sub-goals, which we have actually analyzed all of them and found that 42 of those are relevant to public markets and are investable via public markets. So for us, it's important to map to UN SDGs because in this way we can show that we are allocating capital to those challenges that need to be resolved. And we are also specifying exactly the challenges that we in the public markets believe that we can resolve versus what Jack can do in the private markets.
Okay.
That's why the alignment is important and the mapping to the SDGs is important.
Very quickly, Lawrence, anything to add on that?
No, I think it's when you talk about standardization, it's a common language that an industry can center around to be able to align with some of those global pressure points. I think that's one helpful set of principles we can all map to.
As always, time is flying and we've got some good questions here. So if I could ask you to keep your answers brief to these and we'll cover off as many as possible. A question from Rebecca. How can the investment industry have impact at government policy level? Where can the greatest change be achieved here? Jack.
So
Ingrid, you piped up. Yep.
Yeah, I can take this one. So we have advocacy division and we actually do a lot of government consultation where we are trying to influence policies with regards to whether it's, impactful considerations, whether it's climate change, biodiversity. Obviously, there are a lot of organizations that are also in play here. So we are very active in terms of advocacy. For instance, SFDR regulation, which is the most important piece of regulation coming out. I personally consulted with the EU on this, so there is a lot of that we are doing on this front through our advocacy efforts.
Any other comments on advocacy?
I'd echo in terms of all the industry bodies as well within impact investing, which are cross-border and operate globally. We've recently had the Impact Task Force in the UK, which produced some brilliant work around how we can look to accelerate private capital to do public good. And I think there are a number of initiatives that have been developed or published as a result of works like that. So there's a lot of work going on in the industry.
Question from Jim. How important is group investor engagement around positive impact compared to individual manager action? And that's within the context of greenwashing. Perhaps again, Ingrid, very briefly, as part of your EOS engagement policies, how do you balance group investor around about individual fund managers?
So we engage on a group level through EOS, and given that we have 1.7 trillion AUM under engagement, which is one of the largest in the world, we exert quite a bit of influence. And as a company, we are, fronted as a group, but we also tend to have engagements with other asset managers if there are, some needs that we are seeing that needs to be resolved. So we do it as Federated Hermes, and we also engage with our other colleagues in the market. So it's both ways, individual, group level, and inter-industry.
Any other comments on that? Okay, we've almost covered every question there, but we're out of time, and I will pass on the last remaining questions to specialists to get back to the advisor who's written up one in. If I could just very quickly get each of you to summarize, we spoke before about the future and the trends of impact investing, but it seems to be a rising tide that may or may not float all boats. I mean, can each of you give a brief summary of where you think impact investing is going and why you see it as being so exciting for your firms and for the advisors who are recommending your investments to their clients. Can I start with you, Ingrid, please?
Sure. So for us, we see impact investing as the future of investing. The reason for this being that A, it takes into account all of the stakeholders, not only minorities, and B, that it actually gives you the ability to show how the capital that's been allocated to the strategy is actually helping the society and the environment. Lastly, it's tackling all of the big issues that we are facing as a society and planet. And there is a huge need to put even more capital towards it. The deficit on an annual level for achievement of UN SDGs is $2.5 trillion. And we are seeing capital increasingly moving in this direction because the investors themselves, the capital allocators, are being asked by their end beneficiaries also to demonstrate how the capital has helped the achievement of the UN SDGs.
Lawrence, if I could get a few conclusion remarks from you, please.
If you want gold standard of ESG integration and sustainability, then that's what impact investing naturally incorporates. Now, it also aligns most directly with some of the issues that I think people want to address. And therefore, for me, it is the end destination for a lot of assets. That doesn't mean it's risk-free. That doesn't mean it's simple. It just means it's a phenomenal opportunity if you start to see both capital, but also businesses retool for positive impact.
Final word today to you, Jack, on the future of impact investing.
Yeah, thanks so much, Jake. It's absolutely here to stay and is mainstream. And I think we will see that only deepen as advisor impact literacy, if you will, improves and increases. And I think not only that, will be a recognition of trying to understand the outcomes that their portfolios are delivering. And ultimately, that's what we're looking to do as impact investors. We're looking to deliver positive change, both socially and environmentally.
Ladies and gentlemen, thank you very much for joining us today. Special thanks to our panelists, Jack Wasserman, Investment Director of Impact Strategies at Schroders, Ingrid Kuklian, Head of Impact Investing at Federated Hermes, and Lawrence Taylor, Portfolio Specialist at T. Rowe Price for the T. Rowe Price Global Impact Equity Fund. Thank you for your time. If I can just remind you, a special thank you to Jamie today, all our panelists, as well as the 12 sponsors who have sponsored all the events that we've done. We've hoped you've enjoyed the series as we sign off for this particular series. If you have any questions, please drop us a line. If you want a CBD certificate, which there is today, please drop us a line. And as Steve mentioned, we are coming face-to-face soon as we take the Responsible Pathway live in July. So I look forward to meeting some of you actually in person as hopefully the COVID epidemic subsides. Thank you again for your time, and we look forward to catching up with you soon.